If you've been paying attention to the stock market lately, it is no doubt that we have had a terrible run these past few weeks. And looking at your portfolio and seeing red, it can be very, very disheartening and very discouraging, especially when you're trying to grow your account from a small balance to a large balance, or if you're trying to save money for retirement. It can be very discouraging to see the stock market decline like we've been experiencing over the past few weeks, where trillions of dollars in market value has been lost. And you could be tempted to pull your money out of the market and sit it on the sidelines and just wait it out for a better time before you get back in. But let me tell you why that is a terrible idea and one of the worst mistakes that you could possibly make with your money. With all the talk in the media about Donald Trump, his tariffs, the trade war, and the possible recession that our economy is getting ready to go into, it can be very tempting to run for the hills and take your money with you and wait it out for a better economic time. But the problem with that line of thinking is, when is that better economic time going to come? It's impossible to predict what the market is going to do. Most professional traders who have worked on Wall Street for years will tell you that they don't know what the market is going to do. No one can predict it. Not even the financial gurus on YouTube who are telling you that they know what to do in this market. The market has times when it's up and the market has times when it's down. Today, the market is up today, and then next week it could be down again. So it's impossible to predict what the market would do. And by sitting on the sidelines, you can miss a market run that could possibly take your portfolio to a whole nother level. So to illustrate this example even further, I went to hartfordfunds.com, and on their website, they have an article called "Timing the Market is Impossible." And in this article, they illustrate the 50 best days for the S&P 500 index between the years 1995 and 2024. And what I find so interesting about this article is that 50% of the best days during that period in the S&P 500 occurred during a bear market. 28% of the best days occurred during the first 2 months of a bull market, and only 22% of the best days occurred during the rest of the bull market. So had you missed any of those days, you would have paid. But this next chart is the one that brings it home, ladies and gentlemen. It's called "Missing the Market's Best Days Has Been Costly." So say, for instance, if you were fully invested in the S&P 500 index from the years 1995 to 2024, and you had $10,000 invested, it would have grown to $224,278. But if you missed 10 of the best days, you'd have 54% less. 20 of the best days, 73% less. And 30 of the best days, you'd have 84% less money in your account because you were trying to time the market. So it doesn't pay to try to time the market. So this is the reason why it can be very costly for you to take your money and set it out on the sidelines and wait for a better time. You can miss the best days in the market by being on the sidelines, and it can make all the difference in the world in the value of your portfolio. Think of the stock market in retail terms. When is the best time to buy things? The best time to buy things is when they go on sale. Think about it. You have that favorite outfit that you've been looking at for a long time, and you see the price on it. The price is too high for you to afford right now, or too high for you to spend money on right now. You really can't justify spending that amount of money at the moment. But when it goes on sale, then you're more excited about making that purchase because it's more affordable, or the price has come down within your target range. So a stock is very similar to how you would approach things in retail. You want to buy it when it goes on sale because the price goes down and you can get more of it for the money. And then, unlike retail, you can resell it at a higher price later on as the price increases in value. Let's look at another example. Say, for instance, you are in the market to buy a home, and you go and look at a piece of property that is selling for $400,000. You absolutely love the house. It has the right amount of rooms. It has the right amount of bathrooms, the right amount of space, the front yard, the backyard, the fence all around it. You absolutely love the house. But then you wait it out a little bit, and 3 months later, that same house is now selling for $380,000 because there's been a little bit of a pullback in the real estate market. What would you do? Well, you welcome that reduction in price. You are going to be more willing to buy that house because of the reduction in price. Not because maybe you can't afford it, but because you now see the value in buying that home for $380,000 versus buying it for $400,000. But for some reason, people tend to look at the stock market differently. They see a reduction in price as a bad thing when it really can be a good thing. It just means that things are on sale and you can get it for cheaper than you were able to do before. And what you can do is buy it and wait it out. And when the stock goes back up, you make more money for your portfolio. Simple. CharlesSchwab.com defines dollar cost averaging as the practice of investing a fixed amount on a regular basis, regardless of the share price. It's a good way to develop a disciplined investing habit, be more efficient in how you invest, and potentially lower your stress level as well as your average cost per share. Dollar cost averaging is one of the best things that you can possibly do for your portfolio. And dollar cost averaging, it sounds like a complicated term, but it's very simple. All dollar cost averaging means is you are investing a set amount of money in regular intervals into a mutual fund or into a stock. And what that does for you is when the stock goes down, you are able to get more for the same amount of money. And when the stock goes up, you get less for the same amount of money. But what it does over time, it brings the average cost per share down. So when the market goes up in value, you are able to make more money. So if the market is stressing you out right now, employ dollar cost averaging in your investment strategy because it's gonna help you better to sleep at night. And another thing that's gonna help you sleep better at night is by investing in good companies. Don't invest money in junk companies. During times like these, when there's a downturn in the market, junk companies that don't have any profits, don't have any customers, don't have any potential, those are the ones that slide and go down in value even more. So protect your money and protect your portfolio by investing in good, solid companies. Companies that are making money, companies that you know about, companies that you can explain how they make money, companies that have been around for years. You know they're not going to close their doors tomorrow. Invest your money in stocks that you believe in, stocks that you want to hold for the long term. That's going to put you in the best position to make money in your portfolio and capitalize when things turn around in the stock market and in the economy. So buy the dip. Don't let the news media, don't let economic certainty and people panicking cause you to lose out on some of the best days that you're going to get in your portfolio. Like the chart said from Hartford Funds, some of the best days may come over a 10-day period, and you never know when those 10 good days are going to come. But missing out on those 10 good days can drastically affect the value of your portfolio. And by trying to time the market. No one knows what the market is going to do, but it's always best if you can hold on and ride out the ups and downs of the market and dollar cost average and keep investing in the market and hold, buy and hold. That's why I always tell everybody, buy and hold and having a long-term strategy when it comes to your investments is the best approach that you can take, especially in a market like this. It just works better for you all around. So buy the dip. Don't run for the hills. Don't hide your money under the mattress. Don't pull your money out and park it on the sidelines. Buy the dip because when the market goes on sale, that's the best time to get in on some of the stocks that you may have been looking at for a long time, but just thought that they were out of reach or too expensive to buy at the time. So go back and look at all those stocks that you wanted to buy, Go back and look at all of those companies that you wanted to invest in. Now may be the most attractive time to buy those stocks because of the recent pullback in the market. Buy the dip. Thank you for watching this video. And I want to remind you guys, don't panic. Everything is going to be all right. The stock market always goes through seasons of decline, but after that period of decline, it always comes back and it always goes up, okay? So I appreciate you guys for watching this video. If you are a beginning investor like me and you want some tips and ideas on things that you can do to be successful in the market, watch this next video and I'll catch y'all next time. Peace.